Peter Lynch turned $100,000 into over $1 million again and again, while the rest of Wall Street said it was impossible. He did it not with secret formulas, but by spotting clues as a curious teen caddy and later trusting his own eyes over the experts. Across 13 years at Magellan, Lynch posted an unmatched 29% annual return and became obsessed with a simple question: what habits let ordinary investors capture extraordinary compounding? Unraveling how his first 100,000 grew so explosively isn't just about math. It's about the mindset that made it repeatable. The real secret begins years before the ticker tape. At Braeburn Country Club, a teenage Peter Lynch found himself in the middle of conversations that most kids his age never heard. As a caddy, he listened to business owners and executives talk shop between swings, discussing mergers, earnings, and the stocks that filled their portfolios. Lynch later recalled how these early encounters gave him a front-row seat to the real-world impact of business decisions, long before he ever saw a stock chart. He noticed patterns in the way successful people thought and talked about companies, picking up on the difference between casual tips and informed conviction. By the time he entered Boston College, Lynch's curiosity had turned methodical. Instead of just listening, he started asking questions and jotting down observations. For his undergraduate thesis in 1965, he chose to analyze cyclical stocks, industries that moved in waves, rising and falling with the economy. This wasn't a random pick. Lynch wanted to understand why some companies bounced back stronger after downturns, while others faded away. He pored over annual reports, tracked earnings, and compared management decisions, building a habit of research that would shape his entire career. Years later, Lynch credited these early habits, listening closely, asking questions, and turning over every stone, as the foundation for his signature approach. Finding investment ideas in everyday life, and then digging deep for the facts. The seeds of his "invest in what you know" mantra were sown not in a boardroom, but on the fairways of Braeburn and in the stacks of the college library, where curiosity met discipline. Drafted into the Army Reserve after earning his MBA from Wharton in 1968, Peter Lynch spent nearly 2 years learning the value of structure and perseverance. 11 months at Fort Bliss were followed by 13 more in South Korea, where he managed logistics and led soldiers as a young lieutenant. The routine of inventory checks, the pressure of responsibility, and the unpredictability of life abroad shaped his ability to stay calm and focused, even when conditions changed by the hour. Lynch later described those months as a crash course in discipline, one that taught him to trust preparation over luck and to keep moving forward, no matter the obstacle. Returning to the United States in late 1969, he faced a new kind of challenge: breaking into the world of finance. That fall, Fidelity Investments hired him as a research analyst. His first assignment was far from glamorous, covering textiles, metals, mining, and chemicals. But Lynch didn't see it as a dead end. Instead, he approached each company like a new field problem: gather the facts, assess the risks, and look for what others missed. The culture at Fidelity rewarded this kind of work ethic. Analysts were expected to dig deep, challenge conventional wisdom, and back up every recommendation with evidence. Lynch's military habits, attention to detail, readiness to act, and the ability to lead under pressure found a perfect match in the fast-paced halls of Fidelity. These early years set the foundation for his later success, proving that grit and opportunity often go hand in hand. Magellan Fund's early days looked almost ordinary: a small pool of $18 million in assets managed out of a Boston office with little fanfare. But as the years ticked by, the numbers began to climb, then accelerate. By 1980, Magellan had crossed $160 million. 3 years later, it broke the billion-dollar barrier, a milestone few funds had ever seen. The asset chart from those years doesn't just slope upward, it rockets. By 1987, Magellan managed $6.5 billion, and by the time Peter Lynch stepped down in 1990, the fund had swelled to over $13.5 billion. The growth wasn't just a matter of bigger numbers on a spreadsheet, Each new billion meant new challenges. More eyes watching, more investors piling in, more pressure to keep finding the next big winner. Lynch's portfolio ballooned from a few dozen stocks to over 1,400. The fund became a behemoth, its size both a badge of success and a test of skill. With so much capital, the days of quietly buying up small, overlooked companies faded. Every move sent ripples through the market. The hunt for stocks that could multiply tenfold, the elusive 10-baggers, became harder as Magellan's shadow grew. But the scale also magnified the stakes. For every dollar invested, the compounding effect was visible in real time. A 29% annualized return didn't just look good on paper. It meant turning $100,000 into $1 million in less than a decade. The fund's explosive growth transformed Magellan from a boutique operation into a juggernaut and made Peter Lynch's every decision a headline event on Wall Street. The idea of a 10-bagger, finding a stock that multiplies tenfold, became Peter Lynch's signature ambition. He borrowed the term from baseball, where a home run is a 4-bagger, but in Lynch's world, a 10-bagger meant life-changing returns. This wasn't just a catchy phrase. It was a rallying cry for investors to look beyond steady, predictable gains and hunt for the rare, explosive winners that could transform a portfolio. Lynch's own journey started with Flying Tiger Line, a freight company he bought into during college. The Vietnam War sent demand for air cargo soaring, and his modest investment ballooned 10 times over. That single win paid for his education and planted the conviction that one great idea, held with patience, could outweigh a dozen ordinary trades. He believed that most investors spent too much time worrying about losing a little and not enough time holding on to potential 10-baggers. Lynch often said, "The person that turns over the most rocks wins the game." His process was built around relentless research, but also around the courage to hold on when the story remained strong, even if the market didn't agree. In his experience, the biggest gains came from companies that looked unremarkable at first. Regional chains, overlooked manufacturers, or niche service providers, until their growth story caught fire. Lynch's annualized returns at Magellan, nearly 29% from 1977 to 1990, weren't the result of endless trading. They came from letting a handful of big winners run. He taught that you only needed a few 10-baggers in a lifetime to reach the $1 million mark. For him, conviction wasn't a matter of stubbornness. It was the reward for doing the homework and trusting the facts. The 10-bagger vision shaped his entire philosophy. Focus on the outsized opportunities, hold through the noise, and let compounding do the rest. Invest in what you know. For Peter Lynch, this wasn't just a catchy phrase, it was a mental filter for everything that followed. He believed that the best stock ideas often start in your own backyard. The brands you buy, the restaurants you visit, the products your friends rave about. Lynch urged investors to use their everyday experience as a source of insight, arguing that regular people often spot trends before Wall Street analysts do. But noticing a good business is only the beginning. Lynch's next step was always to classify, because not all stocks are built the same. He sorted every company into 6 clear categories: slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays. This system wasn't just for professionals. Lynch wanted anyone to be able to look at a stock and know what game they were playing. Fast growers might double in a few years if everything goes right, but they can also stumble fast. Stalwarts, like blue-chip giants, offer steadier returns and help anchor a portfolio. Cyclicals ride the waves of the economy, while turnarounds are companies in distress that might recover or disappear. Asset plays hide value on their balance sheets, often overlooked by the market. And slow growers, the most mature businesses, provide dividends and stability, though rarely fireworks. Lynch's mantra, "Know what you own and why you own it," meant more than memorizing tickers. It demanded a simple, honest explanation of what made a company tick. "If you couldn't explain your reasoning in plain language," he said, "you probably didn't understand it well enough to invest." This approach turned the act of stock picking from a guessing game into a process anyone could follow, starting with what they already know. Each of Peter Lynch's 6 stock categories plays a distinct role in a portfolio, shaping both expectations and strategy. Slow growers like utility companies or mature telecoms offer stability and dividends. These are the ballast, unlikely to double overnight, but designed to cushion the ride when markets get rough. Stalwarts, such as Coca-Cola or Johnson & Johnson, bring steady, moderate growth. They're the reliable performers, often weathering downturns better than most and anchoring long-term returns. Fast growers are the engine of potential. Companies like early-stage Walmart or Starbucks can expand earnings by 20% or more each year. These are the names with a real shot at becoming 10-baggers, though they also carry higher risk. Cyclicals found in industries like autos or airlines move in sync with the economy. Timing matters here. They can soar in a boom and sink in a bust. Turnarounds are companies in trouble, but with a credible plan to recover. Think Chrysler in the late 1970s or a retailer emerging from bankruptcy. These bets can pay off quickly if the story improves, but can also vanish if it doesn't. Asset plays are the hidden gems, firms whose market price doesn't reflect the true value of what they own, like real estate or patents. Spotting these requires digging into the balance sheet and thinking like a detective. Lynch's system isn't just academic, it's a toolkit. By matching each stock to its category, investors can set realistic goals and avoid the trap of expecting every holding to be a home run. The mix of these roles, chosen with care, becomes the foundation for compounding growth. Peter Lynch didn't just read annual reports. He got in the car and drove to the nearest store. His favorite research tool was the scuttlebutt method. See the business with your own eyes, talk to employees, count the cars in the parking lot, and notice how quickly the shelves restock. On one trip, Lynch visited a local retail chain he'd heard about from his wife. The store was packed, the staff busy, and the checkout lines long. That first-hand observation started the research, not ended it. Lynch called this turning over rocks. Each visit, each conversation, a chance to find an edge that didn't show up in the numbers. But field work was only half the equation. Lynch needed a way to decide if a promising business was actually a good investment. For that, he relied on a simple formula: the PEG ratio. PEG stands for price to earnings divided by growth rate. If a company had a P/E ratio of 20 and was growing earnings at 20% a year, its PEG would be 1. A PEG below 1 often meant the stock was undervalued for its growth, while a PEG above 1.5 could be a warning sign. Lynch liked growth, but he refused to overpay for it. He would jot down numbers on a yellow legal pad, running the math for every stock that caught his attention. Was the company's growth real or just a story? Did the PEG ratio show a bargain, or was the excitement already priced in? Lynch believed these tools, boots-on-the-ground research and straightforward valuation, were available to anyone willing to do the work. The combination turned ordinary observations into actionable investment ideas, ready for the next step, building a scenario where $100,000 could start to multiply. Turning $100,000 into $1 million isn't just a matter of picking the right stocks. It's about understanding how time and return rates work together. The math behind compounding is straightforward, but the results can be dramatic. At a 29% annual return, the kind Peter Lynch delivered at Magellan, a $100,000 investment grows to $1 million in about 9 years. Drop that rate to 20%, and the journey stretches to 12 years. At 15%, it takes 16 years to reach the same mark. Each percentage point makes a difference measured in years, not months. The formula behind these leaps is the compound annual growth rate, or CAGR. It's the silent engine that turns small, steady gains into life-changing sums. With a 10% annual return, the climb from $100,000 to $1 million takes over 25 years. But at 20%, that timeline is cut in half. The numbers don't just add up, they multiply. That's why Lynch focused so much on finding companies with real growth potential. Every extra point of return shortens the wait, making patience and discipline as valuable as any hot tip. Sizing matters too. The first $100,000 is the hardest to build, but once compounding gets going, the curve tilts upward. Lynch often reminded investors that the real magic happens in the later years, when gains start building on themselves. The lesson is clear. The earlier you start, and the more you let returns pile up, the faster you move from 6 figures to 7. The difference between 10%, 15%, and 20% isn't just academic. It's the difference between waiting a lifetime and seeing results within a decade. Survivorship bias is a quiet trap in investing. It happens when people only look at the winners, like Magellan's record or the handful of stocks that soared, while ignoring the many others that didn't make the cut. Peter Lynch saw this pattern everywhere. He warned that copying the headline-grabbing success stories without understanding the full picture can lead to disappointment and risk. Most mutual fund investors, for example, failed to match Magellan's average annual return of 29% because they chased hot performance and bailed during downturns. The lesson: don't mistake the outliers for the rule. Lynch set up guardrails to keep himself and his investors honest. Diversification wasn't just a buzzword. He spread bets across dozens, sometimes hundreds of stocks, knowing that even the best research couldn't guarantee every pick. But he also had limits. No single position should be so large that a mistake could sink the portfolio. A common rule: never let anyone's stock grow beyond 5% of your total holdings. This way, a few bad breaks wouldn't wipe out years of progress. He also insisted on clear, written investment theses. Before buying, Lynch would jot down in plain language why he liked a stock and what would make him sell. If the story changed, earnings fell, competition heated up, management lost its edge, he moved on. Writing it down forced discipline and made it easier to admit mistakes. Behavioral finance research backs this up. Investors who set rules and check their thinking are less likely to fall for hype or hang on to losers out of pride. Lynch's process was built to protect against the easy illusions of the market. By respecting the risks, setting boundaries, and demanding proof, he kept his focus on steady compounding, not just the occasional home run. Between 1977 and 1990, Peter Lynch's Magellan Fund returned an average of 29% per year, turning $100,000 into over $1 million in less than a decade. This documentary traced how Lynch's early habits, shaped by caddying at Brayburn and rigorous fieldwork, became the foundation of his invest in what you know mantra and 6-category stock taxonomy. His practical rules, like using the PEG ratio and insisting on on-the-ground research, offered investors tools grounded in evidence, not hype. Yet, Lynch's precise decision-making process in real time remains partly obscured, as full portfolio records are not public. Today, his principles continue to guide investors, but the challenge of repeating such returns in changing markets is unresolved. The record shows, with discipline, research, and patience, $100,000 can become $1 million, but the path always demands clarity, caution, and realism.